Hello again, this is Ma'am Buen. So we're going to discuss the last 3 steps in our accounting cycle, and that is preparation of closing entries, next is preparation of post-closing trial balance, and the last one is preparation of reversing entries. Okay, so after preparation of financial statement, that is the statement of comprehensive income, statement of financial position, and statement of owner's equity, we're going to prepare our closing entries. If we said closing entries, it means that we're going to zero out this account. And what are these accounts? These are the accounts found in our comprehensive income, or it is called nominal accounts. So again, we're going to zero out our nominal accounts, and those are accounts that are found in statement of comprehensive income. Sometimes it is called as temporary account. Why temporary? Because it will only be for 1 year, for the period, say, 1 year. Okay, so let us take a look of our statement of comprehensive income prepared before. Okay, so this is the statement of comprehensive income for J. Amante Surveyors. Okay, so all these accounts are called nominal accounts. And what are these? These are revenues and expenses. So we're going to close this account. So we're going to make the balance of these accounts into 0. Okay, so let us have our closing entries for J. Amante Surveyors. So first is this revenue. We have survey revenue of 6,500,000. What is the normal balance of survey revenue? It is credit. And if we're going to zero out, if we're going to close this 6,500,000, it means that we're going to record it in the debit side. Okay, so our closing entry is debit survey revenue 6,550,000 and credit income and expense summary 6,550,000. Income and expense summary is an account title to signify the closing process of the entity. Okay, since we only have one revenue account for J. Amante, so it is just debit survey revenue 6,550,000 and credit income and expense summary 550,000. That is to close the revenue for the year. Why these are called temporary accounts? Because as we said, after 1 year, the 6,550,000 will be closed, and to make a new accounting for the next accounting period. Okay, it means that all these accounts here is we're talking of 1 year period. So survey revenue, that is our revenue for the whole year, for this current year. Okay, then after that we have our operating expenses. Again, what is the normal balance of expenses? It is usually debit balance, remember? So to zero out our debit balance account, it should be on the credit side. Okay, so our entry, so debit, income and expense summary, we don't have amount yet. Then credit, our expenses, we have salaries expense of 3,410,000. We have credit rent expense of 960,000, another credit. Insurance expense of 250,000. We have utilities expense of 160,000. Then we have miscellaneous expense of 80,000. We have advertising expense of 40,000. We have engineering expense of 180,000. And we have depreciation expense of 160,000. Then let us include already our interest expense. Interest expense of 60,000. All of those are on the credit side. And the debit side will be your income and expense summary. So how much is our income and expense summary? It is just the total of this one, 5,240 plus the 60,000. So it is 5,300,000. So let us put now the amount, 5,300,000. Okay, let us check. So we have 3,410,000. Then we have 960. We have 250. We have 160. Then 80,000. 40. 180. 160. And 60,000. Okay, that is 5,300,000. Okay, and the next the next closing entry is since we're done of our nominal accounts here. The next one to close is our withdrawal account. Okay, so explanation for this: to close our operating expenses and interest expense. So number 3, that is, we're going to close our withdrawal to capital account. Okay, so it is at the closing process that the effect of withdrawal to capital account will be recorded. Remember, if we're going to withdraw, it will decrease the capital. So it is through the closing entry that this transaction will affect our capital. So entry: debit amount capital of 700,000 and credit amount withdrawal of 700,000 to close amount withdrawal to capital account. Remember, what we are closing here, we have to make it 0 is the withdrawal. It is not the capital account. So the amount that you're going to use here is the withdrawal amount. So again, our entry: debit amount capital of 700,000 and credit withdrawal of 700,000. Then for the last closing entry is we're going to record our income, net income or net loss. So first is we have to open a new account, that is income and expense summary. Remember that every time you have an entry, the next step is you're going to post it in a in a ledger or T account. So all of this one will be posted to its T account or ledger. But for income and expense summary, we don't have a ledger for this yet. So we have to open an account for this one. So for the first entry, that is 6,500,000. 550. It is credit. So, credit 6,550,000. And then we have our next entry, number 2. This time it is debit of 5,300,000. So, debit 5,300,000. So, this time, how much is the difference? So we have, let us just get the difference. 6,550,000 minus 5,300,000. So that is 1,250,000. Credit side, 1,250,000. Okay. And that 1,250,000 is our net income. So our closing entry to zero out our income and expense summary, our last closing entry is debit. We have to post here 1,250,000 to make it 0. So debit income and expense summary and credit amante capital. That is 1,250,000. This is to record the net income for the period. It is credit balance. The income summary account is credit balance. It means it is an income. Because once it have a debit balance, it means it is a loss. So let us now have our double rule. Okay. Take note, we only have 4 closing entries. The first one is we're going to close our revenue. Next is we're going to close our expenses. The third one is we're going to close our withdrawal. And the last one is we're going to close the income summary to determine whether it is an income or a loss. Okay, so after that, again, as I have said before, every time you have an entry from step number 2, preparation of journal entries, you're going to post it to your ledger. Then you're going to have your adjusting entries. Again, it will be posted in your ledger. And now we have closing entries. We're going to post this also in our ledger. So let us take this one, service revenue. Okay, service revenue. Say this is the ledger of service revenue. Originally, the balance of service revenue here from our worksheet, we have service revenue, survey revenue, I mean. We have survey revenue of 6,510,000. Survey. 6,510,000. Okay? And we have an adjusting entry for that. So, 6,510,000. Survey revenue, 6,510,000. We have an adjusting entry of 40,000 credit. So, we have 40,000 adjusting entries. So, our adjusted amount is 6,550,000. And we have now our closing entry. We have debit survey revenue. This one. So we have debit survey revenue of 6,550,000. So debit 6,550,000. So after that, let us take our capital account. Amante capital. Okay, originally, the balance of Amante capital, we have 1,120,000 credit. So we have 1,120,000. Okay. For Amante capital here, we do not have any adjusting entries. But in our closing entries, number 3, closing entries, debit Amante capital of 700,000. And we have credit Amante capital for the income of 1,250,000. So our ending balance now for Amante capital, let us take it. So 1,120 plus 1,250 minus 700,000. So that is 1,670,000. So that is our ending balance in our statement of financial position. This one. So our ending balance is 1,670,000. So it should match balance with our ledger, because take note, all the amounts here in our financial statement were taken. This is the balances from the general ledger. Okay, so we're done with our closing entries. Again, we have only 4 closing entries. One is to close our revenue, and number 2, to close our expenses, and number 3 is to close our withdrawal, and number 4 is to record the net income or net loss of the period. And that means also to close our income and expense summary account. Okay, then after that, the next step is preparation of closing entries. Since our nominal accounts have now zero balance because of the closing entries, it means that only assets, liabilities, and equity have balances, and those are called real accounts. So, if we're going to prepare our post-closing trial balance, that means only assets, liabilities, and equity will be shown in this report or in this statement. Okay, so for our post-closing trial balance, so it is only the accounts in our financial position, statement of financial position. It is only the accounts and statement of financial position that will be reported in our post-closing trial balance. So that is cash of 210,000. Then we have accounts receivable of 930,000. We have prepaid advertising of 320,000. Then we have engineering supplies of 90,000. Then we have survey equipment of 1,890,000. And accumulated depreciation, of course, it should be on the credit side already. That is 800,000. Then we have accounts payable, credit, 190,000. We have unearned survey revenue of 80,000. We have notes payable of 500,000. Salaries payable of 140. We have interest payable of 60,000. And a monthly capital of 1,670,000. Okay, so our total debits is 3,440,000. Our total credits is 3,440,000. Okay, so take note, in our cycle, we have 3 trial balance. We prepare 3 trial balance. The first one is the unadjusted trial balance. Then we have the adjusted trial balance. And this one, post-closing trial balance. Okay, so let us now have the last step in our accounting cycle, and that is reversing entries. Reversing entries were prepared on the first day of the next accounting period. Okay, and what is this reversing entries? From the term itself, it is reversing, which means we're going to reverse the adjusting entries that we prepared in our on the last day of accounting cycle. In our problem, the last day is December 31. So it means that the reversing entries will be prepared on the first day, which is January 1 of the next period. Okay, so again, let us go back to our adjusting entries. So as we said, reversing entries are entries that will be reversing entries are entries prepared on the first day of the next accounting cycle. And what are those entries? We're just going to reverse the adjusting entries that we have just prepared. Okay, so again, we have our 6 data or accounts that needs adjustment at the end of accounting. So we have the prepaid expense. We have for prepaid expense, we have 2 methods used. We have asset method and expense method. And we have unearned income, we have liability method and income method. We have accrued expense, we have accrued income, budget expense, and depreciation expense. Take note that reversing entries are optional. So it's up to the accountant whether he or she will have reversing entries. So why prepare the reversing entries? Because if through reversing entry, it will facilitate, it will make easier to record the transactions on the next accounting period. Okay, so but not all of these entries, adjusting entries, needs reversal. Only those adjusting entries that increases assets and liabilities needs reversal. So the other adjusting entries that does not increase the assets or assets or liabilities, it means there's no need to prepare reversing entries for that. Okay, so usually what are those adjusting entries? That is, for prepaid expense, if expense method were used. Prepaid expense if expense method were used. For unearned income if income method were used. Also accrued expense and accrued income. All accruals needs reversal. Budget expense and deposition expense doesn't need reversal. Why? Because as I have said, only those adjusting entries that increase liabilities and assets. For asset method, if it is asset method, what is our adjusting entry? It is debit, expense, and credit asset. So, we decreases our asset. So, it means we do not have to make reversing entry. While this one, expense method, our entry is debit asset and credit expense. So, debit asset, it increases our asset. So, it needs reversing entry. For unearned income, under liability method, our entry is debit, unearned, and credit income. So, with that entry, debit unearned, it means that liability were decreased. So, we do not need to prepare reversing entry for that. For income method, our adjusting entry is debit, income, and credit liability. So, it increases our liability, which means we need an reversing entry. For accrued expense, our entry is debit expense and credit liability. So, again, liability were increased. So, it means we need reversing entry. For accrued income, our entry is debit accounts receivable or debit asset and credit income. So, debit asset, it means our asset were increased. So, it means we have to prepare reversing entry. And budget expense, our entry, debit budget expense and credit allowance for doubtful accounts. So, there's no asset involved in that adjusting entry. That is why also with depreciation expense. For depreciation expense, our entry is debit depreciation expense and credit accumulated depreciation. So, for this last two adjustment, assets or liabilities were not involved. So, it means they do not need to reversing entries. Okay. In our problem, here are the adjusting entries that we prepared then. So, for the first one, debit advertising expense and credit prepaid advertising. Again, this is minus asset. So, it means we do not have to prepare reversing entry for this. For this one, debit engineering supplies expense, credit engineering supplies, again, minus asset. So, we don't have to prepare reversing entry. And for the third one, depreciation expense, accumulated depreciation, again, this do not involve an asset or liability. For letter D, we have unearned survey revenue of 40,000 and credit survey revenue. So, debit unearned, that is minus liability. So, it means we don't have to prepare reversing entry for that. For letter E, that is debit salaries expense and credit salaries payable, 140,000. It means salaries payable, it increases our liability, which means we have to prepare reversing entry for this. And also for letter F, debit interest expense and credit interest payable, again, it increases liability, which means we have to prepare reversing entry for that. So, for our reversing entry, we have only two, that is debit salaries expense and it should be debit salaries payable and credit salaries expense. So, from the term itself, reversing. So, we're just going to reverse the adjusting entries that we prepare. So, debit salaries payable of 140,000 and credit salaries expense 140,000. Then, for letter F, that is debit interest payable. Interest payable of 60,000 and credit interest expense of 60,000. Okay, so why do we have to prepare reversing entries? Again, this is optional. So, the reason why we prepare reversing entries to facilitate the recording of transaction on the next accounting period, to make it easy to record the transaction on the next accounting period. Let us have example of this interest payable or salaries expense. When we prepare the entry, salaries expense, that is 140,000. Here. Salaries expense. This one. For salaries expense, the original amount is 327,000. So if this is our ledger for salaries expense, the original amount is 327,000. Then we have our adjusting entry, debit salaries expense. This one, debit salaries expense of 140,000 and credit salaries payable of 140,000. So, debit salaries expense 140. So, the total of this is salaries expense 140. That is 3,410,000. So, this is 3,270,000. 3,270,000. So, it is now 3,410,000. 3,410,000. Okay? And we prepare our closing entries here. So, we have salaries expense, 3,410,000 credit. So, 3,410,000. Which means, on December 31 of the current year, salaries expense have zero balance already. So, come January 1, it is only the nominal accounts that have balances. All nominal accounts have zero balances. So, say, on January 15, total salaries paid by the company, and that includes the 140, is, say, 200,000. Okay? Let us repeat it again. So, say, January 15, the total salaries paid by the entity is 200,000, and 140,000 was already included in that 200,000. If we're not going to prepare reversing entry, the entry that should be prepared is debit salaries expense of 60,000. Then, salaries payable of 140 and credit cash of 200,000. Okay. But if we prepare reversing entries, the entry that will be prepared will just be debit salaries expense of 200,000 and credit cash 200,000. Because if this is our salaries expense ledger, we don't have balance anymore. But take note, for our salaries payable, we still have balance because that is a real account. We have credit of 140,000. Okay. So, if we're going to prepare reversing entry, debit salaries payable of 140. So, it zero out already. It were closed already. And credit, salaries expense of 140. Okay. Then, come our next entry. Debit salaries expense of 200,000. And credit cash, 200,000. So, by preparing yung reversing entry, our salaries expense will also have 60,000. It is just the same as this one. Okay? So, again, as I have said, preparation of reversing entries are optional. So, it is up to the accountant if he or she wants to prepare reversing entries. The reason why we prepare reversing entries to make it easier to facilitate the recording of the transactions on the next accounting period. Okay. So, because if we're not going to prepare reversing entries, again, we have to prepare this entry. But if we are going to prepare reversing entries, it is just a simple debit salaries expense and credit cash of 200,000. Okay. So, for our next video, we're going to have our journalization for merchandising company.